Good morning, folks. So here's another edition of Weekly Wrap. And yes, a lot of juicy stories this week. And it seems like we never run out of stories, right? Okay. So this week, I'm going to be speaking about giving you a quick update on the tariffs, which I don't think we can get away from for some time to come. And since most of the companies have declared the results, let's take the quick takeaways on Q1 results. And GST, of course, artificial intelligence, and this is how we shall wrap up our week's news. Okay. So the US is making it very, very clear that they are in one way or the other going to impose sanctions and tariffs on India just because we are refusing to bow down and continuing to associate with Russia. Okay. It does seem unfair. It does turn the stomach, but this is what it is. And because of all this, India is being edging closer and closer to China and Russia, or rather pushed into a closer association with China and Russia. We never thought last year that we would be talking trade with China in the manner that we are doing so today. And here we are talking to China and saying, why don't you come back and invest with us? After saying that countries on our borders will not get automatic approval to invest in India. But of course, there will be some guardrails, sensitive areas, defense-related areas, technology-related areas. I think the government will still be on guard while inviting investments from China, whereas other areas, I'm sure, will get investments from China. And China has also been reciprocating and taking away our immediate worry on rare earths that we need to manufacture magnets and fertilizers. So both these areas, China said that they would be considering in a fair way, and immediately auto stocks were happy that yes, their EV production will not be held up due to shortage of rare earths. But while Brazil, Russia, China and India are trying to get into a block, we have to be extremely wary because it's clear that US has thrown India under the bus and it's not bothered about the repercussions or impact. Okay. And we as a result are trying to align ourselves closer with Russia and China. China is going to be independently negotiating its terms of trade with America. And I'm sure they will have their way. And once they have their way, what will be India's status vis-a-vis China, vis-a-vis America? So I fear that there's a possibility of completely being thrown under the bus by both America and China. China is quietly negotiating for a large purchase of Boeing aircraft from America. And I'm sure nothing will please Trump more than China putting in another $100 billion purchase order with American companies. So these things are likely to keep on happening, and I think we should remain cautious. I mean, I've been saying cautious for a long time. I've not changed my stand at all as far as caution goes. And already reports are there about close to 2 lakh jobs that will be under stress just because of loss of business in the gems and jewelry sector, not to speak of textiles yet. That will also have I'm sure a significant job loss because of loss of business. So 50% tariffs we cannot fight. Okay, such margins do not exist. Either they get passed on or we just don't do business, and we are in that stage. So the Q1 results that have come out, and there's a lovely full-page graphic on the various components of it, but a couple of takeaways here. Good sign. More companies are deriving their profits out of core operations, and there's a less of an impact of other income and treasury income extra. It's a good sign. Second, we see that a fall in raw material expenses has contributed to margins going up for most companies. So raw material cost has fallen from 29.2% to 28.2% in the last 4 quarters. And this is what has taken the margin up, because the other costs like employee cost and interest cost have gone up. It's only up. And this is largely driven by fall in price of oil and metals. If you remember, there was a time when we thought that the world would go through much slower growth and prices of oil and metals fell, anticipating lower demand. and that helped Indian manufacturers clearly. So the Q1 does not show any significant change in terms of consumption. Has consumption gone up or not? It's still at the Q1 stage was still very, very mediocre. But we do see that profits ex BFSI, that is, if you're taking the net profit of all companies without considering the banking and financial services industries into it, is higher than with BFSI. All along in the last few quarters, except for Q4, we would see that if you took away BFSI from the profit pool, the profits were falling. Banking was contributing to higher than average profitability to the entire set. And with Q4 and Q1, that has actually reversed. BFSI has not contributed to that extent, and the rest of the sectors have contributed more to the profits than BFSI. So let's keep that in mind while we are looking at allocations and looking at the market. So this week we had some good news coming in. Last week we had the S&P rating upgrade coming in, and this week the government threw a complete outlier and said they're willing to reduce GST, and that came in as a wonderful surprise, especially that they want to take away the 28% and the 12% slabs and leave only a 5 and 18% slab, apart from the sin goods high slab of 40%. And the sectors that would benefit from this definitely are automobiles, and then air conditioners, and some packaged food and FMCG. Okay, so immediately stocks of these companies went up, and as a result, you had the auto index going up, the consumption index going up, while the others were very, very lackluster in this period. So what are these two slabs? The 18% slab is the most contributes to the highest contributions to GST collections. Almost 70 to 75% of GST collections are in the 18% slab. So more will be added to this. The 28% slab, which is to be removed, is only contributing to 13 to 15% in the total GST collections. There are only about 37 categories of goods in this. Okay, of course, automobile and air conditioners are the large ones which we can easily identify with, and these prices are likely to come down if these companies choose to pass on the savings to the consumer. There have been occasions in the past where these companies did not pass on the savings. Okay, I'm hoping that they actually do so. The 12% slab also only contributes to about 5 to 6%. So it's not that many items of consumption are going to be positively impacted. It's a smaller number, but well, it is consolidation of the slabs, it is simplification of the slabs, and it's going to make a few things cheaper for us. Okay, and cheaper for us is a key word here. The government is definitely looking at boosting growth by putting more money in the hands of people. During the budget, it was the reduction in income tax, which was anticipated to put about 5.5 lakh crores of consumption, and now it is GST reduction, which will drive more spending or make more things affordable. And this, on one side, the stock market was happy, but on the other side, the bond markets were not happy, because by various estimates, about 1.6 lakh crores of revenue loss will be there for the government. And the bond market said that if there's a revenue loss for the government, it has to make up in some manner. How will it do it? They thought that the government will have to borrow more. If it borrows more, the supply of bonds are going to go up. So the bond market started pricing down the bonds. The yield went up and bond prices fell. So the 10-year G-Sec, which was at 6.4 region, went up to almost 6.51 today. Okay, and 6.55 today as we speak. This is because of the worry that the government will have to borrow more. But actually, the government may be having other tricks up its sleeve. There's a good probability that the RBI's dividend will be higher this year, and that could make up for much of the shortfall. And of course, the whole idea of doing this is to enable higher consumption. So just by higher sales, the government may make up for some of the GST shortfall. Overall, we may have a 40 to 50,000 crores net shortfall after all these things. And that is not too big a sum for the government of India to cover up, nor is it a too big a sum for the bond market to absorb. So, but at the moment, yes, G-Secs, 10-year G-Sec is at 6.55% yield, which in my view is a good yield. So the bond funds have not done well because of this in the last 1 month. Any bond fund which had any medium to high duration of bonds, meaning it had a lot of 5-year, 7-year, 10-year, 15-year bonds in the portfolio, they lost value in the last 30 days. Okay, but I do think that this is a short-term problem and it should recover very quickly. So that's about what's happening with the GST and then artificial intelligence. All right. So the entire week saw the prices of tech companies in the US fall. So if you, especially those related to artificial intelligence. So the artificial intelligence ETF fell by almost 3.5% during the week, which is significant given that these markets are not too volatile and given the almost steady up that we've seen in these stocks. Why did this happen? It was all triggered by ChatGPT releasing its new version, which was ChatGPT 5. The entire market was waiting for the release of ChatGPT 5. There was quite a bit of hype around it, with Sam Altman claiming that ChatGPT 5 would be a step closer, not just closer, that ChatGPT 5 would be equivalent to artificial general intelligence. Not just artificial intelligence, artificial general intelligence is something that everybody is aspiring to move to improve the applicability of AI tools. But GPT-5 was a disappointment. And as the reviews came in from users, it was apparent that GPT-5 was really nowhere close to artificial general intelligence. And that became almost a joke. The questions then started coming in. Have we reached a plateau in AI development? Because most investors, most technologists were thinking that we are going to see a very, very quick growth in AI development, and AI general intelligence will really, really be at our hands, our fingertips this year. But that dream may be a little away. I'm sure it will happen, but a little later. And this news that there may be a plateau on AI development, combined with another report, rather coincidentally by McKinsey. So McKinsey had gone around surveying companies to see how has been their experience in the usage of AI tools. And 8 of the 10 companies that were surveyed using AI tools said there was not much impact or zero impact on bottom line by the usage of AI tools. So while we are thinking that companies are going to use AI, lay off people, increase profitability to no end, I think we are a little away from that kind of a step. Okay. Please do not confuse this with the kind of services companies that we have in India, like TCS and Infosys, etc., who have been laying off people for good reason. That their skill sets do not match and they do not need that bottom layer. But in the usage of AI tools at the largest scale, the user end, well, I think there's way to go. So this is what the media is calling the AI winter, and is it upon us? And at the same time, we have AI stocks falling. A comment which we should take note of in this interview with Sam Altman, and Altman says that investors expect us to spend trillions of dollars. It seems that people are losing track of the number of zeros, but he says that they will have to use trillions of dollars more to reach the kind of artificial general intelligence that everybody is hoping for. Where is trillions of dollars going to come from? It just means also, it just brings into focus that the billions and billions of dollars that are going into AI development by the large companies, the return on equity, the return on capital employed is still a while away. So balance sheets are going to look more inefficient than last year because of the large capex in these areas and the return being a little away. A lot of analysts are talking about the 2000, the dot-com bust area, when a lot of money went into web development, excessive money went into development, and there was no return immediately. The entire plumbing that went into it was used subsequently, but a few years later. At that point of time, it was overkill. Even Altman himself says that it's possible there may be a bubble in the making as far as artificial intelligence stocks are concerned. So, well, if the expert is saying that, I guess we need to be mindful of it. But, well, that's what it is. And there was a rather interesting development during the week when the government of India said that they would like to ban gaming companies that use real money. So it says it's a lot of gambling happening and a lot of people are losing money, and gaming can be there but without using money or without using real money. You can use virtual money but no real money. A lot of companies are disappointed. Obviously, these are the ones who are in the business of gaming. But personally, I think this was a wonderful step. It takes a lot of guts for the government to go ahead and ban something that is popular. But a lot of money is being lost. It does cause addiction, and a lot of people are losing a lot of money. The fantasy gaming business in India is almost a $2.5 billion revenue business. So that's a lot of money being lost. Yes, it is going to result in some GST loss also to the government of India, but I think it's worthwhile. I wish they could do the same with tobacco, but then all they can do is keep on raising the sin GST tax on it and nothing else. Coincidentally, the SEBI is also looking at making tweaks to their policies on options and derivatives to reduce speculation. So the government, I think, somewhere is saying there's too many people losing money, and they need not. If you're losing money with your eyes open and completely aware as a professional trader, it's one thing. But if you do not know what you're doing and you're losing money, it's not a great thing. So can the regulator do something? So they're saying instead of having weekly expiries, they would rather have options and derivatives with longer term expiries. So hedging will not be impacted. Let's remember that the original idea for derivatives is to help you hedge your portfolio. You can still hedge your portfolio with longer term derivatives. Let's just take the shorter term derivatives out of the picture. So let's see, these are all proposals from SEBI's side. Maybe it will work. I generally don't speak about specific companies, but here there was an interesting article here saying that IDFC First Bank's equity dilution habit hurts shareholders. So what has IDFC First Bank done? Over the last 5 years, it's almost doubled its shareholder base, doubled its equity base. So it's called an equity dilution. There's nothing wrong with equity dilution if you're growing at the same time. But in the case of this bank, while its equity has got diluted, it has not really grown its earnings either. If you're diluting equity, that is, you're raising more capital, your existing shareholder should end up earning more by the efficient use of the new capital. But in this case, it doesn't happen. So I'm just trying to say that when you're looking at a company raising money, when you're looking at buying the stock of a company, what is the prospect of equity dilution? Do look at that. It's not often that it happens, but you don't want to be caught in a position where there's too much dilution and not sufficient earnings growth accompanying the dilution. It's just one of the things you should be looking at when you're looking at buying stocks. So that's a wrap for this week, folks. Thank you. Have a good weekend.